Open the newspapers. Read X. What do you see? AI bubble. Nvidia is too expensive. Japan will crash everything on December 19th. It feels like we're back in the year 2000, right before the dot-com bubble burst, doesn't it? Analysts are panicking. You're scared. But there's someone who has data saying the opposite. And it's not some random YouTuber. It's Jurrien Timmer, head of global macro strategy at Fidelity. A giant managing trillions, not pocket change. Timmer has just released a chart that completely flips the narrative. According to his data, we're not in 2000, ready for the final crash. We're in 1998. And if he's right, what's about to happen in the coming days isn't the end. It's the beginning of the most violent melt-up phase in history. Today I'll explain why December 19th could be the perfect trap and why the real peak may not arrive before October 2026. Let's analyze the facts. Fidelity's theory is simple. The current market is rhyming with the dot-com bubble, but we're behind schedule. Everyone thinks we're at the end. Timmer says we're halfway through. Look at this point on the chart in 1998. At that time, the market was flying, but suddenly an external shock hit. The collapse of LTCM, long-term capital management, and Russia's default. It was pure panic. The market lost 20% in a few weeks. It felt like the end of the world. Does that sound familiar? It's exactly how today feels with fears around Trump's tariffs or wars. But what happened after that 1998 shock? Did the market die? No. The Fed stepped in, saved everyone, and the market went vertical for another 18 months. If history repeats, we're heading into the most speculative phase of the cycle. And this brings us to today, to this week. Because if we're in 1998, we're still missing the Great Scare, the LTCM-type shock. And guess who could trigger it? Japan, this Friday, December 19th. The Bank of Japan meets, and rumors say it could raise rates. If that happens, the famous carry trade, borrowing yen cheaply to buy Bitcoin and stocks, could unwind, just like it did in August. We could see a fast, violent drop. A flash crash. Many will use that drop to tell you, see, we were right. It's over. Sell everything. But if we overlay Fidelity's chart, my read is the opposite. A Japan-driven sell-off on December 19th would mathematically be our LTCM moment. It would be the final flush to shake out the weak hands before global liquidity sends markets into orbit. So if you see blood-red screens on Thursday, don't panic. Look at the calendar. It's 1998. Why am I so confident the market will recover even if Japan plays spoiler? Because, just like in 1998, central banks are pumping money like there's no tomorrow. USA, the Fed has started buying $40 billion a month in securities, the stealth QE I've been talking about for weeks. China and Japan. Even if rates rise, Japan has just launched $110 billion in fiscal stimulus. Politics. There's the Genesis mission for AI and a US government that wants higher markets. You don't get a lasting systemic crash when the money taps are wide open. Liquidity always beats fear. Of course, as an analyst, I have to be honest about the risks. Are valuations high? Yes. The Buffett indicator is at all-time highs. But Timmer at Fidelity points out something crucial. Valuations are high, but corporate earnings, the Magnificent Seven, are massive. In 2000, companies weren't making $1 of profit. Today, Nvidia prints money. As long as earnings hold up, the bubble doesn't pop. It inflates. So here's the battle plan for this critical week. Eyes on December 19th. If Japan raises rates and markets shake, remember this video. It's not 2000. It's 1998. What might look like a crash, according to Fidelity, is just the run-up for the final jump lasting into 2026. I'll be here commenting on the data as soon as it comes out. If you don't want to face this storm alone and want to understand which assets to target for the melt-up, subscribe to the channel. History doesn't repeat, but it rhymes. And we like this rhyme. See you next time, and remember, the contents of this video are personal opinions for informational purposes only and do not constitute financial advice. Always do your own research.